Welcome to the How Did They Do It Real Estate Podcast. Have you ever wondered how people succeed in real estate and what steps they took to get there? If so, this podcast is for you. Your hosts, Sayla and Eileen Prack, interview top experts in the real estate community to share with you their real estate journey and how they achieved massive success. Our goal is to provide you with valuable real estate resources and to help you apply it to your own real estate goal. Welcome to today's episode of the How Did They Do It Real Estate Podcast. I'm your host, Eileen Prack, and today our guest is Toby Mathis, and he is a 25-year tax attorney and founding partner at Anderson Advisors, whose career is focused on how to save money and how to make money. And he also advances his clients' interest by combining expert tax advice with his personal experiences investing in over 200 real estate projects in the United States. And his expertise reaches many others through his award-winning publications, including Tax-Wise Business Ownership and Infinity Investing, How the Rich Get Richer and How You Can Do the Same. So Toby, welcome to the show. How are you doing today?
I'm doing fantastic. Thanks for having me.
And also, Toby, I want to really touch quick on your picture in the background there, because we were just talking a little about it earlier and how beautiful it is. Can you please share with us and the listeners out there who might not be able to take a look at it, or the people who are actually watching this on the video?
I'll go to the side a little bit. Yeah, that's Admont Abbey. It's the world's largest monastic library. And that's actually a photograph. That's a very, very talented artist here in Las Vegas named Mario Basner. And I could not resist. I walked by it in the gallery and I'd be nudging my wife going, that is so cool. I could just sit there and look at that all day. It's gorgeous. There's so much detail to it. And eventually I was like, you know what, I'm going to make it my background. Now I can look at it every day. I have to turn around to look at it, but I know it's there.
And now we also have the pleasure of taking a look at it as well. So thank you.
Pretty amazing what people are able to do. Like when you think about hundreds of years ago, they didn't have any of the tech that we have nowadays. And they built these structures that still exist, still last. They're just amazing.
Yeah, and still aesthetically pleasing to look at also.
Gorgeous, yeah. I don't see too many structures like this in our good old U.S. There's some, but like we really could use a few more of just beautiful architecture, beautiful art. And all around the literary arts.
So Toby, can you share with us a little bit more about your background and a little bit more about your focus?
Yeah, so tax attorney by trade, and been doing this for, you said 25 years, long time. It seems like yesterday. So I think it was 97 that I dove in with both feet. And actually something that occurred before that actually colors the direction that I've taken in my life. I have a very good partner, Clint Coons, who grew up doing apartment buildings. You know, a lot of folks have families that may have dibbled dabbled in real estate. Dabbled. There we go. But, you know, he grew up with a father that had multifamily. And so he and his brothers had a little bit of a different upbringing, you know, like, hey, you got to go clean out this unit. You got to go do this. You got to do like they self-maintain. So he had that definitely had an impact on his background. And then in mine, I had a really cool mentor who did believe in real estate, but he was passive. He would buy things in different states and things like that. But he introduced me to a realtor friend of his. And I still remember seeing the list of properties the guy had. His name was Boyd, out in Burien, Washington. And he had hundreds of properties in Seattle and in the Denver area. And he just it was just one of those things where he's like, hey, take a look at the list of our properties. You know, this is what I own. I love buying properties. It's an addiction, da, 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 da. And at the time, I remember thinking, wow, that's got to be worth a fortune. I never even contemplated the cash flow on it. Never even entered my mind that guy had more money coming in on a monthly basis way back then. Like if we thought about it, what it's worth now, I don't even know what those properties were worth then, but you know, 5-10 times whatever the values have increased since then, but also the rents, everything else. Like he basically had a monster cash flow machine. I'm sure he still does it to this day, but I just remember looking at that. I think that was like in 1989, where I'm looking at this sheet and it didn't sink in until years later. And then in my practice, it just hit me like it right in the head. I remember going to Clint going, we need to buy at least a property a year. Then it became a property a month, and then it became even worse. We're over several hundred properties. we're like, it is kind of an addiction. Once you start buying real estate, you just
it's like a collection. What else can you add to your collection?
Hey, I need some single families over here. I need some hey, let's get some storage over, oh, there's warehouses. Oh, there's commercial on sale. Oh, we got to get some of those. It's like the half yearly sale. Every now and again, there's a big sale and you're like, I could use that. But there's lots of tax benefits that come with the real estate. So it goes hand in hand with on the tax side. Obviously, the old joke in the accounting world is if you're paying taxes, it's because you don't own enough real estate, right? There are definitely some benefits that come along with it. And I get the benefit of our firm has about 500 people. We do about 10,000 returns a year, all for investors. And so I can just look at the rich people and say, what are you guys doing? What's over there?
You can peek behind the curtain.
And nobody can lie to me. You ever had a friend's like, oh, I'm killing it in the market. And then, and you look at their Schedule D or, their capital gain sheet, they have losses. I'm like, well, it says here that you lost. Oh, well, that was a one-time deal. I made a mistake, blah, blah, blah. But there's those people that, I'm just killing it. It's usually the gurus too. Like I do a lot of tax returns for people that sell programs and teach and things like that. And sometimes I'm like, hey, whatever you're teaching, if you're doing what you're teaching, stop because you're losing money, right? You just, they can't really snow us because we get to see the financials and the numbers don't lie. Sometimes they mislead, but they definitely don't lie. And so I just take whatever's really working for the wealthiest people. I'm like, hey, I could just reverse engineer it. I can say, like, this is true story is I'm sitting there looking at somebody's return and they have these dividends and I keep seeing it. I said, well, maybe I'll look at a few other returns. And I start grabbing everybody that's making, I'll do an arbitrary figure, let's say 500,000. So I'm like, hey, let's look at everybody who's making over 500,000. Holy kashmoli, they have tons of dividends. And I'm not a huge stock guy, right? But all of a sudden it says, wait a second, not all companies pay out dividends. All of these people have substantial dividends. So they're doing something that other people aren't. And then I started researching and I realized that that's pretty accurate. A big chunk of the S&P return is actually in the form of dividends. When you look at the stock market over time, I think it's 40, 50% of the gains are actually from dividends. So why would you invest in a company that doesn't pay them? And also for cash flow, obviously it makes sense to have cash coming in. And so once you start doing that, you could start identifying the assets that are actually worthwhile holding in a portfolio. You can get rid of all the speculation and the gambling, and you could say, hey, I just want cash flow. Mm-hmm. And it's like this. If you bought real estate, everybody knows a real estate agent that's like, oh, the comps in that area, those houses are worth X. Investors don't invest that way. Investors say, how much is it making? What's the net operating income? Okay, so it's worth this. They don't even need to know what everything else is selling for around the area. They don't care. They're just saying, I invest $1, it generates 10 cents a year. Okay.
Does that make sense to me?
That's it. It's weird that there's still people out there buying on comps, investing on comps, and hoping that the values go up. Like right now, they're getting beat to, they're getting smacked around a little bit, right? For, the last few years, they did okay. And so they were kind of like, they could still do that and be okay. But in the long haul, we've had some serious downturns. You got to have that cash flow. And so if you're investing, it's all about the numbers. And there's very few real assets out there. And once you realize that, you can be very narrow and you could be very focused on certain things. Like I know I saw some of your portfolio and I started laughing because you're in some of the areas that I'm in. I'm in Las Vegas, by the way. And I see that you have some apartments here. And I saw Winston-Salem and I started laughing about that because we've been there for years. And I was like, that's a cash flow area. I'm like, I already know who you are just by looking at some of your investments you're some areas of Vegas, probably that it's not Summerlin. I'm telling you, you're probably in either the downtown or the North Las Vegas area because you want cash flow and you could see somebody's assets and go, I bet you that's a cash flow investor. And that's smart.
We must be doing something right then if we're in the same markets, Toby.
Mm-hmm. Birds of a feather.
So for you, as you've been able to evaluate and you're helping, so many people doing their taxes and everything that you get to peek behind the curtains. Mm-hmm. What makes them what makes them like successful in how they approach taxes and how they invest and how they look at things? And what are some of the things that actually, that they really focus on that helps to build up their wealth?
So Eileen, here's one thing that I would say that will change your life if you can get this concept to really sink in. They're creating something that's infinite, that's perpetual, and that does not die with them. They actually create a legacy. So they're creating a cash machine as opposed to just trying to collect stacks of cash. In other words, if you have the machine that prints it, it's pretty easy. You just make more when you want. So if you buy assets that generate cash, and by the way, my simple definition, dumb lawyer self, of an asset is something that pays you money. So I just look and say, I want to buy assets, something that pays me money and never stops. It's not cyclical. It's not one time. It's not for 2 years. It's perpetual. So in 200 years, it's still going to be kicking out cash. I want that machine. And liabilities are things that pull money out of your pocket. So like your car, your house, and things like that usually pull money out of your pocket. That's a liability. Don't buy those. Let your assets pay for those, but please don't use your labor to buy those. And if you just use that simple concept of I am going to invest in perpetual income streams, things that'll be around in 200, 300 years, it makes your life easier. Even if you're going to exit, because I know in a syndication, you might have a 5-year horizon, but what you're doing is you're building the cash flow machine to make it worth that much more because people will pay more for perpetual income than they will for short-term income. I don't want to buy myself a job. I want to buy a machine that prints cash while I'm sleeping or while I'm traveling. Or if I'm not here, continues to print it out for my family. And then if they're gone, continues to print out money for my descendants or an organization that I care about. What I don't want is short-term, quick, like, hey, this is just a one-time deal, or too much labor, or it requires a bunch of my energy, because that you can't create a legacy with that, nor can you leave it. As we all learn, we create our golden cages, which is a high-paying job, or even if you're in your own business and you're working in your business, eventually somebody's going to tap you on the shoulder and say, if you want to retire, you got to work on your business, not in your business. The business has to be generating this stuff, whether you're here or not. We need to make you an optionable quantity there. Like, you don't need to be around. Once you do that, and if you can just get your head around that, I see people's wealth go phew. Once they start realizing, I'm only going to invest in assets, I'm only going to invest in perpetual assets. That's why I call it infinity investing. We're investing in infinite income sources. And also, if we can replace our expenses or cover our expenses with passive income sources, so rents, royalties, dividends, interest, capital gains from the sale of options, if you do covered calls, these very basic, there's only 5 of them, these income sources. If I can replace my labor with that, in other words, I can cover all my expenses every day, I could live an infinite period of time. Like, I have a cash machine that covers all my expenses. I don't have to work anymore. I'm a volunteer. If I want to go on vacation, I can. If I want to travel, I can. If I just want to sit at home, I can. Right? I'm not required to start changing my time for money, which a lot of people feel like, when they feel like they're on the hamster wheel, or you hear the rat race. I feel like that's usually what happens is they start feeling undervalued, underappreciated. They don't see a light at the end of the tunnel. They start feeling like they're in darkness. And then I talk to people all the time, and I'm like, what are the adjectives, that into play when, like, you have the big mortgage, you're paying for your kids' college, you got car payments, you have a great job, but they say, I feel suffocated. I feel like I'm being strangled. I feel like I'm being, like, there's a weight on me.
I don't have the time. Everything is just moving so fast.
Yep. And the solution is really simple. Okay. Replace the income. Like, buy things. It's like Monopoly. First few times around the board, you better be buying, properties, because if somebody else does, you're going to be paying them for the rest of the game, right? You're collecting rents or you're paying it. And my clients prefer to be on the side that's collecting rents, and if you could just adopt that, hey, I want to buy things that will pay me forever. I can, one transaction, 200 years. You're going to be so much better off. And by the way, I think Warren Buffett is one of the biggest purveyors of this philosophy, which is, I think he says it really, really well quite often, is, my holding period is forever. And if you start taking that mentality, it's like, oh, my holding period's forever. Yes, I might exit. Yes, I might do a syndication. But when I'm building the asset base, my holding period really could be like, I wouldn't care. If I had to hold it for 200 years, I would not break a sweat. There's a lot of wisdom in that.
There is. So among those 5 things that you had mentioned, is there a certain one that the majority tend to focus on more heavily on than the other ones? Or are they mostly evenly distributed on how they invest it and diversify?
So I use a little bit of a version of the Yale model, which was the Yale endowment does a diversification model that's actually quite famous. And I dumb it down to kind of K through 12 so everybody can use it. And what we do is we focus originally, if you're not a wealthy person and you're getting started and you want to buy perpetual assets, I would suggest that you buy something called Dividend Kings and Dividend Aristocrats. Like focus just on, it's not that many. I think it's less than 60 companies in the entire, on the entire S&P or the Dow Jones, whatever. In the stock market, there's over 3,000 companies. It narrows it down to about 60 pretty quick. And what these companies are, larger companies that pay profits to their shareholders every year, year after year, and increase it every year, and have been doing so for more than 25 years. In other words, you get a raise every year. It's like raising the rents every year. But you could invest in some of those for $100, and you start building up a portfolio. That's if you're on that side. But I could tell you where everybody ends up. Everybody ends up in cash flow real estate. I would say that in our diversification model, you can have between 30 and 60% of your holdings in real estate and be pretty safe. I wouldn't have less, and I wouldn't have more. In other words, I wouldn't put everything, I wouldn't have all my net worth in one particular area, but between 30 and 60% to generate rents. And I'm not flipping houses. I'm not, holding for appreciation and hoping that the values go up. No, I want cash flow real estate, something that if I invest in it, it starts paying me on day one a profit, more than what I put into it. And that's probably the number one area because it's the biggest bang for your buck. I was just doing an analysis. The average American spends about, according to the U.S. Census Bureau, about $5,100 a month. So if you're spending let's just call it $5,000, then how many properties would you need to own to replace that? The average rent in the United States is almost $1,400. So I just do my little calculation. I say, hey, I get usually about my net operating income, without getting into too much jargon, is usually about 65%. So, all right. So if I own some properties, let's say that I would net out, if I rent it for $1,350 or something like that, I'll probably net out around $860 to $900. All right. So how many properties do I need? I really need 5 or 6 properties
to have your cash flow covering your just basic everyday needs.
Yep. An average American buying average properties could buy probably about 6 properties and be retired. Never have to work again. Have enough money coming in that they never have to worry about it. And that covers CapEx, the money's put aside for repairs, property management, and insurance and everything else. I mean, we have hundreds of properties, so I can tell you, you probably do this too. You look at kind of your averages. How much net operating income do I get? Conservative is 50%. But the reality is probably closer to 65 or so, depending on what you're investing in. But you could get there pretty quick. And then I look at, okay, well, then how do I buy those houses? Or, could I get that with one apartment building? And you start looking at price per door. And I'm sure that's something you do if you're doing syndications. You're probably looking at it going, hey, I could buy single families and they might be $150 a door. I could buy an apartment complex and buy it for $90 a door. And the rents are fairly equivalent. So a lot of people end up going into multifamily for that very reason. I do a little bit of a mix because I still like the single family space and I like the idea of being able to affect people's lives. Hey, disabled vet, here's really low rent and I'm never going to raise it. That you can't really do that if you're on institutional level. You can't do that if you have a fiduciary responsibility to other shareholders. So I like to buy single family personally so I can do stuff like that. But yeah, an average American, an average family, or an average individual, I think the U.S. Census Bureau was per person. Let's just say it's $5,000. You could replace that and you could buy 5 or 6 properties. I'll just use Winston-Salem since you're there. You could probably buy 5 or 6 properties for maybe $700,000, $800,000. Mm-hmm. So you could retire for less than $1 million. I know plenty of people that are millionaires on paper that are living hand to mouth, right? Month to month. Right. They need their job. They have, so it's actually not a huge ask to say, hey, can I start buying real estate? Even if I just did maybe one a year, you say, hey, you know what? I want to buy one property a year. I don't know how I'm going to do it, whether I'm going to do no money down. Maybe I'm leveraging. Maybe I'm using my retirement plan to do it. Maybe I'm using self-directed IRA, 401k, whatnot. Maybe I'm doing something, but I set a goal. I want to buy a property a year. You do that for 5 or 6 years, you're retired. If you miss and you do it every other year, you're still retired within a decade to 12 years. If I really miss, I'm just really struggling and it's once every 3 years, you're still better off than everything else. Don't do the Wall Street thing where you hand it to somebody else or you're doing mutual funds or whatnot, because most of that return goes to them on average. More goes to them than to you. I would say focus on things like cash flow real estate, focus on things like cash flow stocks, and make your life really easy. In fact, those are probably the two most popular areas that we dive into right now.
So one of the things also is a lot of people, they hear real estate and all the tax benefits that comes along with it. Mm-hmm. The hard part is if you are a working employee and you receive a W-2 statement every single year, how does that apply to you to get some of the benefits of the real estate? And I think that concept is kind of a little bit confusing for a lot of people in the working environment.
Yeah. So in the tax world, there's this thing called passive income. Passive income falls under a section 469 of the Internal Revenue Code, not to get geeky on you, but it was passed in 1986. Big reform, because prior to 1986, rich person making big W-2 would just go and invest their money in tax shelters, which are code for passive income things where it creates tax losses in the first few years. You could still do that to a certain extent, but you'd have to qualify for an exception. So a lot of people, and by the way, before I get too far ahead, passive losses. So if I buy real estate, I can deduct the value of the property, not the land, but the structure that I put on there over a period of years. A lot of people hear 27 and a half years for residential, 39 years for non-residential, and think that's it. But there's actually a way to break it down into 5, 7, 15-year property. And then right now you can actually take anything that falls into those categories, which is usually about a third of a value of a business, and write it off in year one. So in English, if I buy a property that's worth $1 million, and let's say it has a land value of 200 and 800 is the structure, I could probably write off about $250,000 in the first year if I wanted to, if you know a good tax guy. Right? So I could get this big, huge loss, but passive losses only offset passive income. You don't lose the loss, but I may not be able to use it against my W-2. So you see these big losses and immediately someone says, but I have this loss. Why can't I use it against my W-2 income? Well, there is an exception, which is called a real estate professional, that if you work more than half your time and more than 750 hours in a trader business that is a real estate trader business, which could be construction, development, it could be property management, it could be managing your own properties. If you do that, then you satisfy a prong that makes you a real estate professional. And then all you have to do, from a tax standpoint, is you aggregate your rental properties and you materially participate on those rental properties. It's a lot of jargon. There is a path to unlock those passive losses and making them active and offset your W-2 income. The other thing you could do is, instead of investing in long-term real estate, you could invest in short-term real estate for the year. So like right now we're sitting, in the latter part of the year. Let's say that you buy a property right towards the end of the year and you make it into an Airbnb. The tax code actually considers Airbnb not a rental activity. They consider it a trader business, which is weird. If it's 7 days or less average tenancy, so if you have guests come in and the average stay is 7 days or less, then you have ordinary loss. And what that means is you could write it off against your W-2 income so long as you do something called material participation, which means like you manage the property. So I could buy a property. Get this. You'll actually like this. I could be making $1 million a year as a surgeon. And I buy a property that is a Airbnb for now. It's going to be a long-term hold, but I buy it in December. I put it on the market and I rent it, 5 or 6 times during the month. I make a little bit of money. Then I do what's called a cost seg and bonus depreciation, create this big fat loss. And I offset, use the same numbers I just used. I bought $1 million building and I would have a $250,000 loss. And it lowers my taxable income from $1 million to $750,000. And I save, 37% of whatever that amount is, a big chunk of money. That's what you still can do. There's lots of little tax plays when you're involved in real estate, if you know what you're doing. And there's some paths that are well worn, that are established paths that you can walk down, that other people have walked down plenty of times. You just have to know what they are and what the rules are so that it can qualify. And a lot of folks, they have one spouse that might be making the money, another house is staying at maybe a stay-at-home spouse taking care of kids or whatnot. If you can get that stay-at-home to manage your real estate and to be involved in your real estate, you can unlock all those losses. And instead of having passive losses, now all of a sudden I have ordinary loss that offsets my W-2 income and lowers my overall tax bill.
I have a quick question on that. So for the Airbnb, if you're renting it out and it's considered as ordinary law or ordinary income, if you do decide later on to convert it into a long-term rental, what are some of the repercussions or what would happen at that time?
There's none. So if in the first year, so this is why it's fun. I could literally buy a property, make it an Airbnb for the last month of the year. What the IRS does is says for any tax period. So for any year, whether it's a month or 12 months for that year, right? So it's 2022. They're going to look and say, what was the average stay? And so they say, take the number of days that it was rented divided by the number of unique rentals. So, hey, I rented it for 20 days and I had 5 rentals. Okay, 20 divided by 5 is 4. That is not a rental activity. That is a trader business. And boom, now all of a sudden I don't have passive income. I could make it passive, like for all of you tax people out there going, wait, what if you didn't materially participate? Yes, then it's no different than I ran a pizza shop with my Uncle Al and I didn't work in it. It's still passive, right? Even though it's a pizza shop, it's still passive because I did not materially participate. But the type of income is no longer rental, it's trader business income. So there's lots of fun stuff. And then the following year, I could convert that into a long-term rental. I could lease it long. And then for 2023, the IRS is going to ask the same question. How many days was it rented? Okay, let's see. I rented it for 365 days. How many unique renters? 1. So my average use is 365 days. It's a rental activity. That's all it is. That's literally all they're doing every year.
Got it. So they assess it on a year by year basis. So depending on how you decide to structure the tenant or the residence at that time, they'll assess it on the tax for that particular year.
Yep. And it's all a matter of tax appetite. So if I have somebody, I do this a lot with doctors. We work a lot with doctors, and they'll have one spouse that's a high income earner. And sometimes like you'll have 2 spouses that are both doctors and they're working their katushes off and they're making $1 million. And in some states, they're at 50% tax. Everything over 500,000 is really just getting slammed at federal at 37 plus their state. And so we're just trying to soften that blow. It is kind of disconcerting, and people they're like, oh, I'll play the world's smallest violin for those people. They're making $1 million. Well, it's frustrating when you make $1 and you're giving half of it over to a government agency because you have 100% of the risk. They don't share with your loss. They don't say, hey, I know that hurricane just hit your property. You didn't have insurance. We're going to cover that. They don't do that. You're on the hook. So it's your endeavor. Why would you give half of it away? And that's the frustration, is sometimes people feel like like it's unfair, it's unequitable. So here's a way to change that up a little bit and say, hey, you know what? But the government says you can do this and get some relief. Mm-hmm. So let's do the things that give us relief. There's tons of them. There's oil and gas, and there's, there's regular trader business. if I have a whole bunch of passive income coming in, it's not like it disappears if I don't use it in year one. If I'm in a syndication, that loss, let's say that you did a syndication with an apartment building and you're one of the investors and it kicked you $100,000 of loss that you can't use. You carry it forward. The day that they sell or the syndication closes out, they liquidate, that releases and becomes ordinary loss. So now you have $100,000 of loss that you could use against any sort of income. You say, well, but you also have the gain from the sale. Yep, you absolutely do. And that gain is actually considered passive. If it was passive to you, that gain is actually passive. So if you have other syndications with losses that you haven't been able to use, you can use that against the gain. So you can use the loss against other income, and you can use the passive losses you have carry forward against the gain. So it's not a bad thing. That's why people that get involved in syndications continue to do syndications, because the more you do, it actually becomes very beneficial from a tax standpoint to continue to invest in them. Like, don't just do one. You start stacking them. Hey, I'll do one here, one here, one here. I'm going to stagger my exits. Hey, this one's a 3-year exit. This one's a 5-year exit. I'm going to try to get them to be on different years, things like that. That's what the wealthy folks, the really successful people do.
When do they typically start the tax planning activities for the next year to set themselves up for, potential things that might be happening that they're looking to maybe offset or to plan for in the future?
Yeah, I would say that most, like the best clients are the ones that we meet with quarterly, and they're saying, hey, here's what's going on, and this is the reason why, is because you're still doing tax planning for the previous year all the way up until October. I can still cost seg a property. I can cost seg a property, which is breaking it into its components and accelerating depreciation. I can do that after the year end, all the way up until I file my tax return, plus extensions. So I could be making a cost seg election on October 15th for the previous year. I could be making a cost seg election on a property I sold the previous year if it's going to save me money. So there's a lot to do that when we're doing planning. We're also looking backwards and saying, what's the best use of some of these write-offs? Should we take it this year? What's your income? Now that we know your income, how's this next year shaping up? Like, are you going to have a killer year where you're going to be in the highest bracket, where maybe we should keep some of those losses for this year and not take them for last year? You actually have that flexibility. So I would say the best folks, you meet quarterly and you're kind of looking back and you're looking forward, and you're just making sure that your vehicles are set so that you have the best setup for whatever your tax situation is at that time. The best advice I could give anybody listening is, if you are in real estate, make sure that your advisors are in real estate. So if you're going to talk to anybody who does taxes or legal or whatever, make sure they actually do what you do. Right? Don't have somebody guessing. Don't have somebody who does not know, because what they don't know will hurt you, right? You need to have somebody who knows the nuances, because it's a complicated area. It's not rocket science. It's not the most complicated, but it is something where if you don't know it, you're going to be like, there's little nuances that if you haven't experienced them, you're going to miss it completely. And it's going to cost the client money.
Yeah. And not just the knowledge within real estate also, but in your particular niche that you're focused in, because one residential tax advisor who knows all about residential doesn't necessarily know about syndications or multifamily and how that impacts them as well. So focus on the ones that have the experience of what you're trying to do. I know your background. I was laughing because you were in aerospace, right? Yes.
My dad worked for Boeing for 30 some years. Yeah. So like those folks, the engineers, test things. They don't go drive a bad example, but you don't test a bridge by driving a truck across it, right? You do everything, you calculate like crazy. You run all those calculations. That's difficult. Taxes aren't that difficult. You just look at it and it's just, you got to have somebody who's been there and done it. And then they're looking at it going, well, if it's this, it's this. If it's this, it's this. And they're like, well, but what about this? What about this? And you're like, we're not here to argue. This is what the rules are, right? There's code provisions, and the code provision says, here's where you fall. Here's the exceptions. Here's how the exceptions work. And you kind of just know it. You've done it a few times. You're like, oh, here's the logic tree. So I'm investing in this. This is how it's treated. If we're in a syndication, like we have really no control. The syndicators are controlling whether a cost seg is done, whether it's kicking out these losses. Usually they do it because it's like an interest-free loan from the government. Like, hey, I'd rather, not pay taxes now. I'd rather pay them later. You're always better off deferring. So they usually do these things, but you're kind of in the passenger seat on that one, right? So you can just react. And so then you just want to have somebody who says, oh, this is how it came down. This is how it's treated. Here's your options if you want to offset it.
Got it. Well, Toby, how has real estate investing impacted your life then so far?
I've been really, really lucky. Like I've been at Infinity for a long time, right? So we have enough money coming in from our real estate to where it makes everything else kind of voluntary. And I can say it's had a huge impact on my clients. It's had a huge impact on, I do stewardship with folks. Sometimes you're sitting there talking to somebody who's in debt, who doesn't see, like I'll use an IT professional, since I know that's something a lot of people can relate to. Hey, they're working in computer sciences or they're doing things like that. And I had a professional who was in debt. She and her husband, not in a great spot, right? And you're just kind of showing them, hey, you're really an intelligent person. Like you're way smarter than you need to be to do this. They think it's more difficult and they don't even want to touch it. A lot of people just close their eyes and they don't want to deal with the reality of their economic position. But one of the things that really comes into play is you look at it and you realize how much stuff is available to them to have an immediate impact. And so this one individual, this is about 6 years ago, I talked to her, way in debt. She and her husband were like, oh my God, when am I going to be able to retire? And she hit Infinity about 6 months ago, does not need to work anymore. They just travel around and they keep killing it. Like, because they figured out the basic principles, they keep hitting home runs, and they just hit another home run. So it's like, I'm looking at this going, I remember crying individual, not knowing what their future was going to look like, not worrying that they wouldn't even be able to retire, worrying that they're always going to be in a situation where they're working 40 hours a week, 50 hours a week. And they did not see an end to that. And then we just sat back and took a look at what they had available to them, and we were able to restructure it. And they caught on so quick. And a few years later, they're actually independent. She actually retired from her IT job. And it was like, well, that's cool. Has enough money coming in and again, just travels around and does her own thing. And by the way, one of the most gracious and caring people. I get to do that. And so I look at it and say, I get a little buzz when you're working with people and you're able just to tweak things because you're surrounded by people telling you all the stuff you can't do. Right? Oh, you shouldn't do real estate. You're going to lose your butt. Oh, you're in the stock market. What are you, dumb? And they're doing all this stuff and they're always telling you all the stuff you can't do. And they're just complete naysayers, right? Got to just ignore those and sweep them out of the way. And then you see somebody take control and have big success. There is a buzz that comes along with that.
Well, Toby, I could sit and talk with you for hours at this point. It's just really interesting from what your perspective is and how you've been able to help and support people and looking at their taxes and how to, achieve that infinity investing and that lifestyle that they're looking for. But we are running out of time, Toby. So I also wanted to make sure that our listeners also are able to reach out to you and learn more about what you're doing if they are also interested. So Toby, where's the best place that they can go?
Google. Just type in Toby Mathis. You will find me. There is something, tobymathis.com, and you do /podcast. That's what my people always tell me. But here's the reality. Just go to Google, Toby Mathis. You're going to see my YouTube channel. It's free. You're going to see I do something called Tax Tuesday every other Tuesday. Answer any tax questions you have. It's free. And there's lots of ways to get resources. My firm teaches classes every 2 weeks on tax and asset protection. It's free. Like, we just love to go out and educate and try to find investors or get people involved in investing. Look at it like this. If I was a barber, I want everybody to have really thick hair. And so I'm a tax attorney, guys. I need you to get rich because unfortunately poor clients don't really need me. So it's like, all right, so we need to help everybody get very, very wealthy. Helps our practice out a lot. Asset protection only helps if you have assets to protect. So I gotta get you wealthy. so that you need me. And so we'll do everything we can to get you there.
Awesome, Toby. Well, thank you so much for all of your time and your knowledge today. Really appreciate it.
Eileen, thank you for having me.
And thank you for listening to our podcast today, brought to you by Untitled Capital. We would really appreciate it if you can go to iTunes right now and leave a rating and written review. Also, please don't forget to subscribe so you can always get the latest episodes. You can also connect with us on Facebook, How Did They Do It Real Estate. We'd love to hear your feedback and any topics that you're interested in for future episodes. Lastly, to learn more about us, you can go to bonavestcapital.com and fill out the Contact Us page so you can speak to us directly. Nothing on the show should be considered as specific personal advice. Please consult your legal, tax, and real estate professionals for individualized advice.